Hey folks, it's Wednesday and we are having a conversation with Mr. Kihara Maina, the regional CEINM, and that's because they are in the market raising debt, that is via the issuance of a corporate bond targeting about 10 billion shillings. The pricing is at about 12.2%, fixed rate I should say, and the tenor is 5 years. And of course, we are privileged to have this gentleman on set to help us make sense of this issuance. Kihara, karibu sana.
Asante sana.
We meet again in very short order.
Yes, very soon after our results.
Yes. So, Kihara, let's start from the macros. I saw your indication to the market. We're looking for debt, raising 10 billion shillings. And I thought, what an interesting timing for issuance, considering we're seeing a bit of an inflection on the yield environment. Never mind it's a fixed rate bond, but help us understand the timing of the issuance and why now.
Thanks, Julian. So I think there is always a balance that you have to strike when it comes to issuing debt. You, as an issuer, looking to get the most appropriate pricing. If you can time the bottom of the interest rate curve, then you're in a good space, considering this market particularly likes fixed rate paper. So we have seen a couple of issuances that have already come out. We've seen the long curve that came down all the way from 2022, interest rates coming down, and they'd kind of reached a bit of a resistance point at around 7.5% thereabouts. So we felt that the timing is right to get into the market. We had already mooted this as part of our capital plans, so it was really just an issue of timing. We also wanted to be able to use the most recent results that we had. Otherwise, you have to audit your accounts all over again just for that purpose.
Yes.
So having had 2025 audited results just released not too long ago, this was the right time to get in. I
see. A floating issuance could still have worked for you, I thought.
So floating would have met a few investors' requests actually. In our own case, perhaps that would also have meant that the early part of the life of the bond would be slightly cheaper, let's say, because you'd have to use a floating rate benchmark like either 182 or 91 day paper to be able to price that. So yes, it would certainly have met a few investors' requests, because they would be looking at whether interest rates are expected to go up. And if interest rates are expected to go up, investors tend to ask for floating rate instruments so that they can time when to fix as well. However, the predominant interest in this market is always fixed rate.
Okay.
Yeah.
Makes sense. It's targeting strengthening I&M's subordinate debt. And when I looked at, and we sat down of your full year numbers at length, I didn't get the impression that from a capital adequacy standpoint, you really needed to get this kind of a buffer. Just help us understand what's the plan behind it. Is it a bit of a replacement cycle you have in mind with this? Indeed,
it is actually part replacement. So we've got about $75 million of tier 2 debt that we already have on our books, with varying dates for maturity, some as early as 2027. And we felt that we needed to be able to replace that. Now, we had already in our plans put in room for medium-term note. So the medium-term note is actually for 20 billion. It gives us flexibility then on how much we can take in terms of issuance. This tranche is for 10 billion shillings. With a green shoe for 30%, so we can take up to 13 billion. Yeah. But the idea is that rather than wait for the maturity to come in or get in now, and this particular one is in Kenya shillings. What we had before on the books is in US dollars. Actually, let me correct that. It's actually $50 million that we have running. Yeah. So this was the right time to get in, because it allows us to front load that tier 2, as well as anticipate now the maturities that are coming up, and build the pipeline now for the second tranche as well. Just how much of a key consideration was that FX element from USD to KES in this return to market? So our preference actually has always been to issue in Kenya shillings, right? But the realities of the markets in the past few years have been that it's been a bit difficult to do corporate bonds in Kenya shillings. Yeah. So the last two issuances we did were actually in US dollars. So given that one was a single issue to was an issue to a single investor, that's IFC, $50 million, it makes sense for them to do it in the currency that they typically do it in, which is in US dollars.
Yeah.
The one that we had done and expired not too long ago was in US dollars around the time that we were having challenges with the Kenya shilling issuances. And this was a private placement, really. So we had just about $27 million or so that we ended up doing. We did it in US dollars at the time. And it was also timed that when I think we were having a lot of dollar liquidity following a tax amnesty that had been given by the government.
Yeah.
So it was an appropriate investment vehicle.
Okay.
Yeah.
And I saw the ticket size for this return to market and the green shoe factor, and I said, Kihara and team must have done their market sensing and gotten some very good appetite signaling from particularly institutional players.
Yeah.
Any context into that?
Well, so our advisors on this bond are Standard Investment Bank, and you know they have advised on several issuances as well. They did a market sounding, got the kind of interest that different investors are looking at. And we were advised that we actually should be going for a larger amount, right? Even though we have a 20 billion program, you'd think let's sort of do it into 3 tranches.
Yeah.
The advice that was that actually this market would like to see bigger issuances and maybe just 2 tranches. So if we do get up to 13 billion shillings, then it means that the next tranche is 7 billion,
yeah.
right? Which is still a small size, but what it will benefit from is the price discovery that comes from the trading on this first one.
Okay.
Yeah.
I'm looking at the pricing of the issuance and imagining, so we have 12.2%. What sort of a deployment are you looking at in terms of maybe a sectoral focus? Mm-hmm. Because 12.2 vis-a-vis what you could lend in this market also, there's a bit of a dynamic there you need to really consider.
Yes, indeed. So we have been expanding into our retail and SME space, I think as part of our Imara strategy. And you can appreciate that a lot of clients there are looking for longer term for borrowing, even though it keeps on resetting every so often, but typically they want it on a fixed rate basis. We have an appreciation that there's going to have to be a blend. It's a mixed pricing. So yeah. Even if it's coming in at 12.20, we have about 38% of our deposits on CASA. So we know that it will moderate it down, and then what it gives us is long-term liquidity as well. But so there's no specific sectoral focus, I would say, but it does give us the options for clients who are then looking for long-term funding, and even for the odd 1 or 2 corporate clients who then ask for fixed rate funding as well.
Okay. Any subsidiary play to factor in as we think about this issuance?
So for this particular issue, no. What it does help, of course, is with the credentials as an issuer around the region. Lots of the investors who have expressed interest in investing in this bond are also from the wider East African market. So if they're willing to invest in the Kenya paper here, then certainly they'd be willing to invest in, say, the Rwanda paper if one does come to market. We do feel that the operating entity is best placed to issue the paper. Yeah. So Kenya has issued, I&M Kenya here has issued the paper. It's not the group that has issued the paper. So deployment will be here in Kenya. What that then means is that if there's tier 2 issuance that's going to be done in any one of our subsidiaries, it will be done on that balance sheet, right? But the idea is just to also make sure that the wider credentials as an issuer are appreciated.
Are strengthened.
Yeah.
Fantastic. Kihara, in the recent past, the issuances which have come to market, we have seen a deliberate effort by players to try and push corporate bond issuances downstream by way of ticket size to be able to crowd in the retail segment of the market. Mm-hmm. From an I&M perspective, it doesn't look to me like that's the case. Mm-hmm. What would be your response?
Right. So I think here we have to also appreciate that fixed income is not as readily understood by investors, particularly retail investors. I know if you asked people whether they can lose their capital just simply by trading out the bond at the wrong time, right? They wouldn't understand sometimes whether or not that is the case, right? Because the reality is that people have appreciated how deposits work, right? And those are capital protected, but they don't appreciate, bonds and how they work, right? So, and because people tend to hold instruments to maturity, then that isn't too much of a problem, right? But I also think that we have to be careful when we are coming in as issuers to make sure that people understand the instruments that you are offering to them. Yeah. And the CMA in particular has taken a lot of effort to make sure that issuers are putting out the right information to potential investors and who it is really that they're targeting. They also have put in mechanisms for facilitating access by retail investors, right? And the way to do this is through collective investment vehicles, right? And whereas the minimum subscription amount at the primary is 500,000 shillings for the I&M bond, the denomination is actually 50,000.
Yes.
Which means that if you're then trading in the secondary market, you can buy for 50,000 shillings and you can sell for 50,000 shillings. But I would encourage that, of course, people talk to their advisors, speak to particularly collective investment vehicle providers to then say, okay, are you putting this as part of your portfolio so that I can buy unit trusts? At least those are a lot more familiar. But I think it is important that investors are always informed when they're making their investment decisions.
Absolutely. Kihara, which key timelines are we looking at? And I'm asking that because we, of course, are doing this also for educational purposes. What are the key timelines you're looking at as far as the issuance goes?
Yes, so the offer opened on the 30th of April. That's when we announced it. It's the MTN program. It's while the program is open for I think it's 5 years now, which gives us the timeline to be able to issue within that period of time. This particular offer opened 30th April and closes on the 15th of May. So there's a pricing supplement that has been put out that captures those details. The key dates, the rates, the minimum subscription amount that I talked about of 500,000, the denomination of 50,000, the offer open and close dates, who the different placement, well, the placement agent is, the different advisors are on the bond. So it's important, of course, that people understand where to go for further information. It is listed on our website. There's a link there to the application form. There's a link to the information memorandum so that everybody can also see how to access the bond. There is a link to facilitate this application process. So we're taking advantage of the CMA regulations that allow this now. So we are hoping to see a lot more applications come in on the digital side. It makes for much easier processing. Yeah.
Kihara, I wondered when I was going through the supplement, was there a case for an amortization structure here? And I'm asking that because of the liquidity component it brings, especially given how pricing is now evolving in this market.
So yes, there was a case for it in a sense, right? And I'll tell you where it's coming from. So because this is a tier 2 issue, it's a subordinated debt issue. It means that for purposes of counting it as capital, we have to start from year 5 going on. We have to reduce its capital strength by 20% every year, right? Okay. So while we would take, say, 10 billion, within 6 months' time, we would now start saying, okay, yes, we will count for the first year 10 billion, but after that, we would have to count 8 billion as capital, and so on. So from our perspective, if we're using it as for capital purposes, we have a strong case to then say, okay, fine, let's have an amortizing structure that then says we'll pay out 2 billion after the first year and so on, and reducing it that way. But remember, we're doing this for liquidity purposes, for on-lending as well. So it made sense for us to keep the amortization structure as just simply a bullet payment at the end of 5.5 years.
Okay.
So that was really the thinking behind the structure.
You know, I really struggled with that when I was going through the documents, but that helps me understand how your reasoning went about it.
Yeah.
I want us to speak broadly about the corporate bond market.
Yeah.
A number of things here, Kihara. Where do you feel the market is? You and I appreciate there was a time where the corporate bond market was extremely difficult. Mm-hmm. Then here we are where we are having a lot of froth with activity. Everyone who has come to market has told me we need to push this market to price for balance sheet strength. Mm-hmm. And not yield chasing necessarily.
Yes.
Do you feel we're getting there as a market?
I think that there is still a lot of work to be done to create depth. And as I&M, we feel strongly that we should be, as one of the tier 1 banks, we should be playing a role in providing the kind of diversification that you need for fixed income really to work. This may sound a bit curious because obviously we are a bank, but I feel that we should really provide alternative capital markets funding instruments for corporates, right? So that your needs are not always fulfilled just simply by the banks, right? True. You can get too much concentration, and then what that means is that if the banking sector is averse in a particular cycle to to providing credit to the private sector, then, if you don't have a strong capital markets issuance program, then people are starved of capital. And you need to strengthen the capital markets in that regard. So I think the more issuances that come out, the better. Now, the bit that we don't see is secondary market trading, right? And that's simply a depth issue. Tight. Yes. Because every investor who comes in says, well, okay, I do want to, like in our case, we're priced at the 5.5-year mark, right? Which means that people who are looking to fill that particular point in their portfolios will find this attractive. And what that will mean is that as it comes down to maturity, it's obviously coming down in terms of tenor, but it remains relevant for them until perhaps they decide, okay, maybe I can switch it out and get a 1-year treasury bill in 4 years' time. But most investors, because there's so little corporate, in terms of corporate paper out there, what they do is say, I'll buy and hold, right? Yeah. So the paper then never gets traded as it should. And what would happen is if you had more issuances coming out, then you would get a lot more trading happening in the secondary markets of the papers that you get. I think, as you said, yield chasing then tends to be a thing. So you're having conversations about where the price should be, and people only have one comparator, pretty much, which is the government securities curve. But they then need to be doing their homework and saying, okay, so what kind of premium should we be charging for a corporate issuer so that we can price this right? Now, only when you're trading are you then really seeing that price discovery coming through. And it would help then any other issuers who are coming in and saying, okay, fine, relative to I&M, where is my company positioned? What kind of margin would I expect to pay? And these things then start encouraging issuance. Now, and this is why we have initiatives like the fixed income exchange to be able to facilitate this. Because if we're only trading government securities, then it will help with solidifying that government curve. But you need the corporate curve to also come in.
But to be fair, Kihara, given just what you've said, many of the players I talk to out here will tell me, the problem with the Kenyan market is this: unless I am I&M, unless I am Safaricom, unless I'm EABL, the risk of an undersubscription and what that will do to my profiling in the market is quite scary. Mm. Isn't that a genuine point, Kihara?
Well, The reality is that even government securities get undersubscribed.
But that's a sovereign.
Right. So it isn't something to fear. Honestly, I don't think it is something to fear, right? It is the market giving you feedback about pricing, about structure, and so on, right? Which is why you do medium-term notes, right? Because then it gives you the flexibility to say, okay, fine, I'm doing 20 billion shillings over the life of my medium-term note. Maybe it gets undersubscribed, and I come back to market and say, okay, fine, I was looking for 10, I got 9. I can get another 5 next time I come to market and so on, which is why a medium-term note is a good structure. But I don't think it would be the reason that people are scared to come to market. Sometimes it's just the fact that you do have to work with a lot of advisors. It takes a bit of time. But in other markets, some of these things happen, from idea to execution in 6 weeks. Here we've been mulling about it for a while, and we started the discussions with our advisors sometime, and then in earnest started working on this about maybe 3 months ago, and getting all the documentation that we need in place. So sometimes that can be a bit daunting, but I think if you're confident, your name should really be driving the pricing that you get, and different initiatives, even things like risk-based pricing that have been happening in the banking market, are really intended to drive that kind of discovery on pricing, so that if this is where all banks price me, then this is perhaps where the capital markets will price me based on that extrapolation.
Okay. Kihara, let's close this. 2 months ago, you and I sat here and I really took you to task about the variance between the growth in your deposits vis-a-vis the growth in your loan book. Given what you're raising in the market right now, what sort of anticipation should we have around the evolution of your loan book?
So we know that we are not bigger than the market, let me say. No one bank is bigger than the market. So if the demand for credit is still subdued, then we have a challenge. Obviously, we're planning with an expectation that you're going to see growth in credit to the private sector. It's right now at about 8%. We hope to be able to match that in our numbers. I think we talked about that at our last discussion. But it will still be driven by just simply the demand that we see out there. We are focused on growing our retail business. So retail lending is something that we've been doing in earnest, particularly driven by digital lending. So while the volume at a spot balance might look small, the actual volume when you rotate the lending is actually quite a lot. Then of course the SME space, we know that we have to be relevant in the sectors that really are important to people in the country. And therefore we are also looking at solutions across agriculture and so on, and how do we make credit available and affordable there. So I think it can only help our chances of growing the book based on the demand that we see.
I see. Kihara, let's close this conversation. And here's your moment to make a pitch. Speak to the market about why this issuance and why it should be top of mind.
Yes, so this is a 5.5-year bond issue. It's a medium-term note program. It's 20 billion shillings in total size. 10 billion shillings this tranche, with a green shoe option, so we can take up to 13 billion depending on how subscribed to the issue is. 12.2, attractive interest rate. It helps you feel a particular tenor in your portfolio at 5.5 years. And you're going to be seeing this from a seasoned issuer. We have been in the capital markets before. We still see it as a responsibility that we have to be able to deepen the financial markets. So we are really keen to see investment interest in this. We know that it isn't limited in terms of investor interest. It's not just Kenyans that can invest in this. We are not actively, as obviously we're not required to do so, but we know that there is already interest from East Africa, the wider East Africa, and we are confident that it is going to help fill a particular gap when it comes to the corporate paper issuance, because we're the most recent, in recent times, a tier one bank that has come to the market with the debt issuance. So we're really looking forward to seeing how this develops and seeing how this actually helps to deepen the financial markets.
We've been having a conversation with Mr. Kihara Maina, Regional CE at I&M, speaking about the corporate bond issuance which is currently in the market. As he said, the MTN is 20 billion aggregate size, currently seeking 10 billion with an option of, green shoe option, I should say, of 3 billion shillings, 12.2%. That is the coupon on the instrument, and we shall keep you updated as and when this evolves, because the capital markets and especially the fixed income segment has become quite vibrant. Keep it Business Redefined.